Welcome to my channel. I'm Dr. Romano. In today's video, I'm going to discuss with you what do the returns look like for a funds of funds, and what is exactly a funds of funds. What are the risks of a funds of funds? So, as you know, I'm Dr. Hedgefund for a reason because I specialize in hedge fund selection. As you know, I'm Dr. Hedgefund on YouTube, and I have a PhD in financial management and leadership, and all of my research is on hedge fund selection. So I dedicated myself to YouTube to create videos about hedge funds, investments, etc. And today we're going to talk about a funds of funds and why it is so beneficial and so important to be part of your investment portfolio. Now, the issues that people don't like to hear, there's double fees, etc. That's not something that you should be focusing on. You should be focusing on managing your risk. You are not a doctor like myself that understands on how to select and deselect a fund for a portfolio. You shouldn't be investing directly into a hedge fund. It is a bit risky in a way because you are not able to maximize your returns in a portfolio. Whereas myself or funds of funds managers, they're able to do that. A funds of funds is a portfolio of hedge funds, and depending on who the funds of fund manager is, it could have 20 hedge funds in that portfolio, it could have 10, it could have 7 or 5. It just depends on the strategy of that funds of funds. There is a magic number, and that number is between 7 and 8 hedge funds in a portfolio. No more and no less. The reason is because when the markets are moving, you want to have 7 hedge funds in that portfolio because you'll be able to make the 50% return when a market is doing really well. When you have 8 hedge funds in their portfolio, that is watered down, and so you don't want to do that. But when the markets are trading sideways and they're just not doing well, you want to have that extra fund in it to bring it up to 8 hedge funds so that the returns are a little bit better when markets don't move. As of today, for example, there should be 8 hedge funds in a funds of funds. Also, please subscribe and do thumbs up. It's right there. It doesn't hurt. Just press it. But that will really help me out. Thank you so much. The risk of a funds of funds is very minimal. Let's look at it this way. So if you put up $1 billion and that fund of funds has your $1 billion, are you going to lose all your money? And I'm going to say no. The fact is that funds of funds distributed the capital into 8 different hedge funds. Each hedge fund is trading the capital. Each hedge fund has a track record. Not only does it have a track record of 8 to 10 years, but you have to also remember that actual hedge fund, they had a track record before they were trading, and they created experience and talent. So just because they only have a 5-year-old hedge fund or a 10-year-old hedge fund, they were trading many years before, at least 3 to 5 years before that. They've already traded through a stock market collapse, a stagnant economy. They've traded through all the different market conditions, etc. So they're very proficient at managing capital. Next, you have to also realize that the funds of funds manager has to know what type of market that's going to be happening in the next 2 to 3 years. For example, the next 2 to 3 years will be a stagnant economy. We have a president that's about to change office or could stay in office. If he stays in office, taxes will go through the roof. That will create a stagnant economy. If the president changes and we get another president, well, taxes may not go up and the markets will go up once again. But for the next 2 years, even if the president does take over, a new president, it takes about a year for those policies to take effect. So again, that's a minimum of 2 years. So in this 2 years, the markets will trade sideways to a certain degree. Which hedge funds and how many hedge funds to put into that portfolio. And this is why it's better to invest in a funds of funds than a hedge fund. Now, of course, just because a large hedge fund has $1 billion or $1 trillion in capital, or 200 million or 200 billion, it doesn't mean that they're competitive enough to make those returns. They're not. They have watered down returns. And so that's why you should focus on smaller companies. Now, as I mentioned, the risks. So in 2008 and 2009, we had 6 investment banks left. After all those mergers, they all went bankrupt. If it wasn't for the federal government to step in and lend that money as last resort, that's what the federal government's job was, we would not have a banking system. That's risk. Your mutual funds, that's risk. Investing in an investment bank, that's risk. But 20,000 hedge funds out there in 2008 and 2009, how many of those actually went bankrupt? It's a fraction of a fraction of a fraction. You get the point? So to say to yourself, oh, hedge funds, you're going to lose all your money, that's not true. Because you're not going to invest all your money in one hedge fund. It's not in an investment bank. So that's why a funds of funds is a much better opportunity, because you have diversification, you have professional and talent managing and distributing the capital. You also have the measures that kind of, not that it's a guarantee, but it's there's a trigger. There's also the administrator and the hedge fund accountant. That's a separate organization that is the one overseeing where the capital is, how the legal documents, are they legal, are they up to date, and are the returns accurate, etc. So you have the hedge fund accountant making sure that each hedge fund is having their audits done and preparing those documents. The administrator is reviewing them for in case the SEC does an audit. So that funds of funds is a much better alternative to invest directly into a hedge fund, because you have a professional team at the administrator, a professional team at the hedge fund accountant, making sure that your capital is where it is. So to say to yourself, oh, they're going to walk away and take all your capital, it's not true at all. Maybe in other countries, maybe in 10 years ago, prior to 10 years ago, that was true because there was less regulation. But now the regulations actually proved itself over 10 years. How many hedge funds have really went bankrupt and took all your money in the past 8 years, and it's almost like it doesn't even exist? I understand Sam Bankman-Fried, what he did, but the SEC didn't regulate cryptocurrency like they do in the equities market. So that's why he was able to commit multiple counts of fraud. Secondly, he raised almost $40 billion in 2 years. So he really did tell the investor what they wanted to hear, but yet he didn't follow that. You have to be very careful when a market's new. That's why you should have stayed out of the cryptocurrency market until it was regulated. Now it's going to get regulated, and the government's going to create a really good plan to regulate them. Whereas the plan for the equities market, it's already been working well. So that's what a funds of funds is, and I'm going to share with you what a hypothetical funds of funds should look like. Now, a hypothetical funds of funds should look like the years that the markets really move, they need to do incredibly well. And for 2017, the hypothetical funds were 27.89. For 2018, 24.98. For 2019, 28.67. And the most important year was 2020, 51.68. For 2021, 15.25. For 2022, negative 16.24. So if you take the average return over the past 5 years, including 2020, that's an average return of 20%. So if you look at the past 5 years and remove 2022, the average return was 30%. If you include 2022 and you look at the last 5 years, the average return is approximately 20-something%. That's an incredible funds of funds. And so for an investor to have your capital almost double within a 2 to 3 year period, that's really incredible to be invested in. And so I want to share with you what that what an actual funds of funds risk profile looks like. And so part of these types of investments, you want to stay invested in that particular funds of funds for a number of years. Because the longer you are invested in that company, you're a client of, in other words, you have the higher likelihood of making a really good return. So it's not a short-term investment. You have to stay in the investment a certain amount of time based on all the hedge funds, what their lockup period is. So let's say it's 1 or 2 years, and so forth. And so the question is, are you going to make 30% return in the real estate market in the 2-year period? And that's no, unfortunately. So again, in 2020, if you had been an investor, let's say in that funds of funds, is your real estate portfolio going to make 50% return? No, it's not. And someone could sue you and take half of the real estate from you. So that's a huge risk. Whereas if you're a funds of funds client, unfortunately, it's not that high risky like a real estate portfolio is, or a venture capitalist deal. So venture capitalists invest in companies that are either starting up or they've been established and they want to become bigger, and so they grow the company, they help them grow, and then they sell it for a profit. But are you going to make a 50% return in a market that moves? No. It just depends what that deal was, what type of market that deal started at and finished at. And it could take 10 years before you actually make that 50% return. To those venture capitalists out there, you should be becoming a client of a funds of funds. For those people out there that don't want to manage real estate, you should become a client of funds of funds. For those people out there that have $2 to $3 million in an investment portfolio, you should be focusing on investing in funds of funds. For those people who are out there that have a private foundation, have a lot of value in that private foundation, you should be focusing on funds of funds, not hedge funds directly, and so forth. And because the taxation for a funds of funds is short-term capital gains, if you have a private foundation, you're only paying tax on the short-term capital gains, which is a lot less than personal income tax. So again, a funds of funds and hedge funds are a better investment because the capital gains tax is much lower. And if you are not a US citizen and you live elsewhere, it's even cheaper for you because, capital gains tax in your country could be, or personal income tax in your country could be 0. And so you're only paying tax on the capital gains. And so that's why it's really important to become a client in the funds of funds. And how do you find a funds of funds? Well, you have to join databases such as Eureka, Barclays, etc. And it costs a lot of money to belong to those databases. And you do your research, you look at all the different funds of funds, etc. And I hope that this video gives you value. And please remember, I want to say thank you so much for watching. Also, please subscribe and do thumbs up. It's right there. It doesn't hurt. Just press it. But that will really help me out. Thank you so much.